Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, that 10% slump in the S&P 500 index, the technical definition of a correction reached Thursday, has been much more painful for those in the fastest growing tech stocks. As is always the case, the market darlings turn to pariahs when the bottom falls out, and 5 stocks I'm following have crashed an average 29% since the sell-off began late January. And while I don't think the overall selling is quite finished, I'm starting to buy the dip in the most promising tech stocks because when that rebound happens, it's going to be fast and these stocks will make new highs. I'll reveal each of those along with the price targets and the stocks I'm watching this week, including updates to Supermicrocomputer and SoFi Technologies. But first, I'll show you those tech stocks to buy the dip next, but there's also another group of stocks I'm buying. In fact, I call these my forever stocks because I don't even have to research them anymore. I just let them run higher and the proof is in the returns, with the group up an average 94% last year alone, and one of the picks up 100%. I'll leave a link to the report on those stocks in the description below. The report is totally free. You're going to see that first stock immediately, and it'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. Back to our main topic though, and with the S&P 500 falling to 10% from its recent highs last week, we are officially in a correction. And while the last 2 years have been a one-way ride in the market, these small hiccups are actually pretty frequent. In data by Yardeni Research, the S&P 500 has seen 56 corrections in the last 96 years since 1929, or about one every 2 years, with 7 in the 17 years since 2008 financial crisis. The good news is that only about 4 in 10 of those have seen stocks keep falling into that bear market, or about 20% or more down, and in those that didn't become a crash, the average correction was just 13% and lasted just 4 months until the market reached new highs. Of course, whenever I talk about the pain in a correction being relatively quick and light compared to the 4 crashes I've invested through since 2000, I always get comments to the effect that, oh, I've gone batshit crazy. And that's because when the overall market falls 10%, the pain in those high growth and those most popular stocks is always much worse, like smashing your finger with a hammer, but with the claw end, and it's covered with lemon juice. In fact, the top 5 stocks held on Robinhood, including shares of Palantir and Tesla, has fallen an average 19.6% over the past month, just shy of that technical bear market, and double the pain felt in the broader market. Worse still, some of the highest growth tech stocks that have done so well in the bull market are giving back even more. The 5 stocks I'll highlight next are down an average 29% since the sell-off began, with 3 of them well into the bear market of 20% or more. But while everyone else is trying to time the market's bottom, worrying about how much worse it can get, smart investors are looking at that 20 and 30% discount in growth stocks and thanking their luck. Nation, I never understand it. When the market and stocks are making new highs, everyone wishes they had bought in at cheaper prices, but when those cheaper prices come, everyone's too scared to take them. Now, I'm not suggesting that you jump in on every stock that's down 20%, or that the market won't give back another 5% or more. Now, this sell-off likely has a couple of months and a few more percent to go, but there are none of the hallmarks of a bear market, and that means opportunity to buy the dip. That's why I'm looking for tech stocks, those expected to continue posting those 20% plus revenue growth in the AI and the other growth themes that are now trading at much more attractive valuations than just a few months ago. And the first stock I'm buying here is the biggest loser, the Trade Desk, ticker TTD, down 54% this year. Trade Desk is a leader in e-commerce advertising with more than 10% of the cross-device ad targeting category, and any market leadership in that digital ad market is going to mean huge growth. Trade Desk estimates the digital ad market at just $135 billion, a fraction of the $900 billion global ad market. The company beat earnings expectations by a long shot and reported revenue up 22% on the year, but missed their sales forecast last quarter, sending the shares diving, but sales are still expected to grow 18% plus this year and next. On $2.9 billion in expected revenue this year, the shares are now trading under a 10 times price-to-sales valuation for the first time I can remember. In fact, the stock generally trades twice as expensive, above 20 times on that price-to-revenue. And here, a stock I've been wanting to buy but always seemed too expensive, ServiceNow, ticker NOW, down 25% since the January high. Agentic AI, that business automation and assistance that have been the first real use cases in artificial intelligence, is just getting started and is going to be the next evolution in the theme. ServiceNow holds a competitive advantage and is ranked number 1 or number 2 by market share across this theme in IT operations, project management, and asset management. That means the company will lead in that transformation to robotic processes, already working with over 8,000 global customers and with a 98% retention rate. And here again, sales are expected to grow at a healthy 19% pace through next year with 2025 forecasts for $13.1 billion in revenue. The price has fallen to 16 times on reported sales, well under the valuation over the last year. It's not cheap like a screaming buy, but on this year's forecasted revenues would be just 13 times the price to sales, which is a very good deal for this stock. Another stock we've been watching in this AI theme, this one getting crushed 35% from mid-January, shares of Arista Networks, ticker ANET. I've detailed how networking equipment is likely to be the next big constraint, the big bottleneck in AI that sends prices higher, and Arista is the data center switching leader, specializing in the kind of high-speed, low-latency networking that those AI data centers need. Its EOS software is a key differentiator, offering better programmability, automation, and scalability compared to maybe Cisco's legacy systems. And that single, unified operating system means better reliability, automation, and scalability across all of ANET's products. That networking demand should keep Arista growing at that 19% forecasted rate this year and next, with $8.4 billion in revenue expected for fiscal 2025. The sell-off has already taken shares down to 15 times on a price-to-sales basis, but on that expected growth, are trading even more cheaply at just 12.5 times multiple for the cheapest it's been in years. And here's one of my favorite stocks in that data center AI theme, Broadcom Inc., ticker AVGO, now down 19% from its January high. And again, while I've highlighted that networking equipment theme as the major bottleneck in the AI data center buildout, Broadcom is the best all-around AI play here. Not only does Broadcom dominate that networking theme with its Ethernet switches and network processes, the company supplies data storage solutions with its RAID and tri-mode controllers. Its ASICs and custom silicon also support hyperscale AI workloads, and a hardware-based security is available through its TPM chips. While revenue growth is expected to slow to 16% next year, I think it keeps it closer to that 20% pace forecasted this year on that dominance in data center infrastructure. Even on the $63 billion in expected sales this year, though, the shares are now down to 14.6 times on that price-to-sales valuation. Now, that's not quite as cheap as some of the others here on the list, but still a very good deal considering where Broadcom usually trades at. And my favorite in the cybersecurity theme, CrowdStrike Holdings, ticker CRWD, is still up for the year, but down 22% from its February high. I started buying CrowdStrike after that massive outage last year when researching the company found that its Falcon platform is the best available for enterprise protection. Its AI-native security is driving a 27% growth rate in annual recurring revenue, a subscription revenue that is extremely sticky and just keeps growing. CrowdStrike is leading in the kind of AI-powered security that I think is going to be the next evolution in that theme, with detection speeds fast enough to stop those AI-driven threats. Cybersecurity stocks haven't been affected by the AI fears around DeepSeek, and that demand should continue to grow no matter what happens to the data center infrastructure demand, with forecasts here for CrowdStrike to grow at a 21% pace this year and next. The sell-off has been relatively lighter here too, though, with the stock still trading at 21 times on that price-to-sales basis, and even on this year's $4.8 billion forecasted revenue on an 18x multiple, so this one isn't quite as cheap as the others, but is still a buy-the-dip opportunity. Looking at the stocks I'm watching this week, and the ProShares Ultra Gold, ticker UGL, is up 4% in a week following our video March 5th, as gold reaches that new record over $3,000 an ounce, and providing investors with that traditional safety haven this year. You've got three key factors here for gold. First, central bank buying around the world as leaders try to break the dollar's dominance as a reserve currency. Then you've got investor demand in the stock sell-off, and a stated policy goal of dollar weakness by the Trump administration. It's all like a trifecta for gold, and we're likely to keep seeing that price rise. Another option here, gold miners in the VanEck Miners ETF, the ticker GDX, are up 22% since recommending them in a video mid-November for stocks that beat inflation. Also watching Supermicrocomputer, ticker SMCI, was easily one of the most volatile stocks last year, but is now protecting investors from the worst of the sell-off. Shares have found support around $40 each and are flat over the last month versus an 8% loss on the S&P 500 and an 11% plunge in tech stocks on the NASDAQ 100. It doesn't mean that SMCI is totally out of the woods here, but really the only two overhangs are that Department of Justice probe and the overall market worries on demand for AI infrastructure. Now, I expect the DOJ probe to be wrapped up soon with no smoking gun against the company, and hyperscalers like Amazon, Alphabet, and Meta are still planning on spending hundreds of billions of dollars to build out those data centers. My $70 plus price target for the shares is supported by the company's advantage in that AI server space, and the still low valuation on the shares should continue to support the price even if the market falls further. SoFi Technologies, ticker SOFI, continues to be a little too expensive for me to pick up new shares even after the 30% crash, but announced news last week that should keep growth booming to reaching new highs eventually. The online bank announced a $5 billion funding program through Blue Owl Capital to be used to originate new loans. This follows a $2 billion agreement with Fortress Investment Group in October and means all the liquidity the bank needs for new loan growth. SoFi reported 34% member growth and 24% revenue growth last year, which is even more impressive when you compare it against 6 to 8% growth of those legacy banks like Bank of America. Revenue is expected to continue at that 20% pace this year and next to $3.8 billion next year. And while I continue to hold 15,000 shares, one of the largest positions in my portfolio, and up $74,000 on that position, I'm still hesitant to add more at this price. Their shares are trading at an expensive 1.9 times price to book value, and while that high growth should continue, I'm waiting for more like $10 a share to start really buying again. If the broader market sell-off doesn't take the stock to that point by the end of this summer, I might consider adding more for that longer-term growth upside. Showing you that bigger picture here with the Sector Spiders Sector Tracker, 2 of the 11 stock sectors did close higher last week, with utilities serving their traditional safety status and energy stocks finding support on a bottoming in the price of crude oil. The sell-off in the rest of the market, though, was surprisingly broad, with 8 of the other 9 sectors all falling 2% or more. Now, this broad and uniform weakness is a clue that the market may not be done falling. When we get closer to that end of the sell-off, we should see pockets of strength emerge in at least a few of the sectors. Another point I'm watching, the sell-off in consumer stocks, both the discretionary and staples sector, was particularly worrying last week. Consumer spending is 2/3 of the economy, and cracks are starting to appear across all the income levels. CEO commentary from retailers was especially worrying in recent earnings call, with Walmart CEO McMillan saying customers are buying smaller pack sizes at the end of the month because their money runs out before the month is gone. Dollar General also reported its customers are even having to sacrifice on the necessities. And here we see household savings and checking balances have fallen to near 2019 levels at all income levels, with consumers giving back pretty much nearly all that pandemic stimulus savings they accumulated. And businesses at the luxury level are even starting to see that pressure lately, with management at Kohl's and Macy's calling out the consumer weakness last quarter. Combine all this with a plunge in consumer confidence this month to its lowest point in 3 years, and we're likely to start seeing some of that scary economic data come out on spending. Not only does it mean stocks in the consumer goods sectors have more room to fall, but the entire market is likely not done falling. Looking forward to the news this week, with corporate earnings all but over and little economic news expected. It's going to be a wait-and-see week for stocks, a sentiment sure to be confirmed by Fed Chair Powell when he speaks after the central bank's meeting on Wednesday. We will see retail sales data for February released Monday before the market opens. Expectations are for a rebound of 0.6% from January's surprise 0.9% plunge in sales on that month-over-month basis, but recent data on consumer spending has me wondering if we won't be disappointed again. The high-income consumer, about the only consumer to continue spending, has shown signs of a pullback, and that's going to affect data over the next few months. The Fed does wrap up its policy meeting on Wednesday, but is unanimously expected to keep rates unchanged. The CME FedWatch rate tool, a futures-based estimate of market-based expectations for those interest rate moves, puts the probability at 99% chance that the Fed leaves its target rate alone. Worries of a slowing economy have moved the market to expecting up to 3 rate cuts this year in June, September, and December, but all this is going to depend on that pace of inflation. Data from the CPI and the PPI reports last week shows that that pace of inflation is coming down only marginally, and it's going to be late summer before we see the true effects of those tariffs coming through on prices. That's going to tie the hands of the Fed in that wait-and-see approach, and it's going to limit any rate cuts unless the economy really falls apart. And nation, with that continued uncertainty, it's difficult to have much optimism that the sell-off in stocks is over. The effect of government layoffs and reduced spending, and more importantly, the secondary effects of layoffs from companies that relied on that government spending, is yet to show up in the data. Now that's going to start showing through the next month and over the following months. We'll see the full picture on tariff implementation through April and May, and likely the inflation consequences later in the summer. So unless we see some strong stimulus in other parts of the economy, stocks are not going to rebound higher and may trade sideways at best. As we've talked on the channel, the good news in all of this is household finances are still relatively healthy, and the financial system is not overly leveraged like we've seen in the past, so there doesn't appear to be that catalyst for a full stock market crash, even if inflation does increase. The average time for stocks to rebound from a correction like we've had is just 4 months, and data back to 1929, which, even if we have to wait for a lower bottom, should mean that stocks still rally to close the end of the year higher. Get your free report and see the stocks I'm buying for the next 30 years, my forever stocks, with the link in the description below. Or click on the video to the right to see the 5 stocks that will replace your income. 5 stocks to buy now to retire your job. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.